Here's the top 10 money terms that you need to know if you want to become rich. So here are the top key terms. Number one is wealthy mindset. Number two is asset class. Three, diversification. Four, return on investment, ROI. You hear a lot of people talk about that. Number five, stocks and bonds. Number six, cryptocurrencies. Number seven, real estate. Eight, liquidity. Nine, risk tolerance. And 10, Reaganomics. Wealthy mindset, the positive mental framework that emphasizes deserving wealth and understanding its implications beyond just earning money. It's more than just money, folks. Once you get that, acceleration begins. An overarching framework that emphasizes not only the importance of acquiring wealth, but understanding its deeper implications on personal wealth building, societal roles, and a broader perspective of wealth beyond mere financial gains. It's the opposite of a scarcity mindset. Beware of the scarcity mindset. It's a disease. Asset class, a group of financial instruments that have a similar financial characteristics, behave similarly in the marketplace, and are subject to the same laws and regulations. The main asset classes include equities or stocks, fixed income or bonds, real estate, commodities, increasingly now digital assets like cryptocurrencies, beware of the kryptonite. Each offers a different level of risk and return and will react differently to economic events. That's why you want uncorrelated assets. When we talk about diversification between and amongst asset classes, this is why each is unique in the pros and the cons. Diversification, a foundational investment strategy that involves spreading investments among various assets or asset classes to reduce risk. The secret is that different assets will respond in their own way to economic events. When one might be declining, another may be increasing, thus potentially offsetting losses. Now, listen, when we talk about diversification within and amongst asset classes, let me just talk about asset class. If they're uncorrelated, which I just mentioned, then you really reduce the risk because they're not going to be subjected to the slings and arrows, especially if it's uncorrelated to the stock market. An asset that's the opposite or it has no effect will be protected against that no matter what. That's a good place to be when it comes to your money time freedom. ROI, return on investment. That's what it stands for. It refers to the profitability ratio of an investment by comparing the cost with the reward. This helps you compare the efficiency of different investments by evaluating the return of an investment relative to its cost. It's a great measurement tool to see what kind of level of risk you need to take. Sometimes people take extraordinary risk to get 10%, when if you really find an easier, softer way through proper planning, you could take on less risk to get to that same 10%. This is going to show you how to figure that out. Stocks and bonds. Stocks represent ownership shares in a company. When you buy a stock, you become a shareholder owning a piece of that company and its potential profits through dividends and or capital appreciation. You buy the phone, the Apple phone, right? But imagine every time you bought the phone, you bought shares in the stock. That's how you would own the company stock, right? Now, bonds are a little bit different. It's a loan agreement between the bond issuer and an investor, where the issuer promises to pay back the loan by a specific date with interest. Bond examples would be government bonds, corporate bonds, and savings bonds. Cryptocurrencies. Representing the intersection of finance and technology, cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional currencies, they operate on decentralized platforms, and by the way, beware of the kryptonites because they're coming for your money if you're not careful, and can serve as a medium of exchange or store of value. Their decentralized nature means they're not controlled by any government or financial institution, which means people that don't have licenses tend to present these to folks, so you got to be careful of it. Real estate. This tangible asset class encompasses land and any structures on it. Investing in real estate can offer both cash flow through rental income and potential appreciation in property value. Liquidity indicates how quickly assets can be converted to cash without significantly affecting its price. Liquidity is crucial for understanding the fluidity of investments. Cash is considered the most liquid asset, while real estate, certain collectibles, or specialized business assets might be considered relatively illiquid. Risk tolerance, any individual's capacity or willingness to endure swings in the value of their investments. Reaganomics, Eddie. This is for Eddie Gartner. The economic policies instituted by President Ronald Reagan during the 1980s emphasizes tax cuts, deregulations, free market principles. These policies had a significant influence on the U.S. economic policy and investment environment. Reagan's policies were based largely on supply-side economics. The idea that reducing taxes and regulations will stimulate economic growth by encouraging production or supply. Thanks for checking out the video, folks. Continue to follow by downloading my free book to become a financially educated person when it comes to the epic path. Go ahead, click the link below. One of my team members will take you through the process, answer any questions. Continue to like, subscribe, and always share our good message.